opportunities for me to serve and then to be of service to retirees. I'm very happy to do that. Okay, roles and responsibilities of the board. So FCERS is Federated City Employee Retirement System. So we are trustees of the plan. We have certain a scope of services. As you know, the council, the city's the plan sponsor, the council represents them. Provisions within the plan are to a great extent negotiated with the city. So that's taken care of through the unions and through the city council, then transmitted to the retirement side. And then once things are within the retirement realm, then we've got the board of trustees as well as the administration and all the consultants. We all have our respective roles. Trustees on the board of directors, we have a responsibility to ensure the exclusive benefit, that the assets are used to exclusive benefit of the members. So we are all about taking care of the monies and making sure members get all that they're due. We're also interested in trying to ensure the timely delivery of the benefits or your checks and any other new things that might arise. We oversee the prudent investment of not just the employer, to minimize employer contributions, as well as the employee contributions, maximizing the investment returns in a responsible way. And then we provide the actuarial services. We ensure that those occur, so there's always an accurate value on what promises have been made to all the plan recipients, and how are we doing in terms of funding those future benefits. And then lastly, all the provisions are reflected in plan documents, and our job is to ensure that we administer according to the plan documents.
Excellent.
And then I wanted to show you the status of the board. So we have a 7-member board of trustees. Matt Lesh has been on he's the chair. He was appointed in 2007. He's already announced that he will not be seeking re-election come November when his 12th year expires. I'm vice chair of the board, and I'm chair also of the audit committee. I was appointed last year. And then we've got 3 other people on the board, and these are not typos, it's true. 4 of us were appointed last year, so it's a very new board, it's very much in transition. We had 2 vacancies occur in the last few months, and we've had a process to try to fill them. Not successful yet, but we are going to be talking about that at our board meeting next week for additional strategies for getting those 2 seats filled. In addition to the monthly board meetings, we do have 4 ongoing committees. Each of those committees requires 3 people. So when we have so many vacancies, it does create an extra load on the committees, and trying to get a quorum of 2 out of the 3 people is scheduling.
Jay, do you want to use the mics? You just got it hooked up.
Ah, okay. Can everybody hear me okay?
Yes.
All right.
Is there, I thought it was the city council person, or no longer?
So there is a non-voting member from the council. That's Deb Davis. She's in addition to the 7, but she doesn't vote. Yeah, thanks again for bringing that up here. And then highlights for this last fiscal year. You remember the issue about pensionable pay corrections. That is all taken care of now. For those of you who don't remember, the auditor brought up an issue a few years ago about data coming over from the city to the retirement system that was not fully accurate. So a number of retirees were underpaid, a number of retirees were overpaid, and we had to go through the process of adjusting. For those retirees who were underpaid, we were able to retro and compensate them right away. For the retirees who were overpaid, there was a process about how to deal with the extra money that they've gotten, and in the end, we decided as a board to have the city pay for it through the unfunded liability. So it just became an extra part of the Right now, our plan is about $2 billion underfunded, and adding another, I forgot, was it 1 point something million? Yeah, adding that to the 2 billion underfunded liability was not a big impact. So those retirees who received too much and owed back, they didn't have to pay out of pocket for those. But prospectively, they are getting now the accurate amounts, not the higher amounts.
You know, we can thank the leadership for Jay on that. The full amount, not limited to just the 3 years under a statute of limitations that police and fire had to deal with, but the full amount going all the way back 15 years was forgiven for Federated. Jay, let's lead on that, make the motion that the board to approve that.
We have updated our discount rate, that's our assumed earnings rate, to 6.75. You know, if you're watching the market is, the interest rates are very low, and 6.75 does require a good investment strategy that will return more than just the regular, T-bill rates, for example. Roberto will show you on a slide later on that we are one of the few plans that have been much more reflective of reality. The 6.75 is conservative. There are a number of plans that are much higher. Again, Roberto will show that to you. But we have dropped our discount rate. It does affect how much we think over the next 30 years we'll earn. So that creates a higher contribution rate on behalf of the city primarily. But we have done that. The council, have they already adopted they're building that into the budget process now, right? The new pension administration system went live earlier this calendar year, so it was a very dated system, and it's now been updated. We know that there's an issue on the paychecks. You see an extra line there, and I know someone's going to ask Roberto about that later on today, so we'll get that. But for the most part, we are feeling much more comfortable that we have a system that will operate and can meet our future needs. And for those of you who have been watching the PAS thing, the implementation, the lead on the retirement side was Barbara Heyman. And Barbara Heyman, if you haven't heard, she's now the new Donna Bussey. So Donna Bussey was the deputy director who retired last month or 2 months ago, and Barbara Heyman is now the new deputy director of retirement services. And then last week, April 19th? I'm sorry, I have the wrong date.
It was April 30th.
April 30th. We had a joint. What's that?
It was the right month.
The right month, yeah. Joint meeting with the board, police and fire board, and the city council. I'm sure that's all archived on video, available on video now. But I thought it was a very positive meeting. Very great opportunity for the council to better understand the challenges in funding the system. We started off the meeting showing a video that I believe is accessible on YouTube.
Yes.
That showed the interest rates every month since 1980, and they would hover in the 5, 6, 7, 8 range, and if you've got a discount rate of 6.75, that's great because you just put your money into savings and you're going to earn the rate that you need to fund the system. But as you know, starting especially around the 2000s, the rate has dropped down to 2, 1, barely above 0. So that puts a lot more pressure on the investment team to create investment earnings above and beyond that prevailing interest rate. 6.75 is quite a bit. So that's why I'm happy that we've dropped the rate to something much more realistic. And the cities acknowledge that that's more realistic, and they're going to fund it accordingly through the contribution rates. So those are the highlights I wanted to provide for you. Are there any questions about the slides that you've seen? And then we'll do Q&A later on too. But anything about the slides that you've seen so far? Okay, so thank you, Dennis, for swapping out. And I'd like to introduce Roberto Pena, Executive Director.
Thank you, Jay. So I'm not going to use a microphone. I think you can hear me. My wife tells me that I'm loud, so, and I believe I am, especially in the morning. If I'm in the afternoon, I'll be a lot more subdued, so this is good. So I have a presentation today, what they bring it up on the screen. Every year I come before you and really present the results of the actual evaluation, which is a report that the actuary produces that tells the stakeholders what is the status of the plan in terms of not just the fund status, but also the contributions and everything else. So the presentation, I made this presentation, part of it, to the City Council every year, have some of that data. I also included slides that we presented, as Jay indicated, in the joint meeting with the City Council. So the idea is to give you a sense of the status of your particular plan, federated plan, but also I have some slides that have information for both federated and police and fire, as well as some data comparing us to other pension public plans across the state of California. So with that said, I'll go to the presentation. You certainly can ask me questions as we go along, but then at the end, I'm happy to address any issues that you may have. Would you be kind enough to? Yep. Thank you. Okay, so that's the first one. That just, I like to present this, and it just is a very general understanding how the pension plan works. So really, in essence, the way that the money comes into the pension plan is three ways. It comes from employee contributions, which all of you made when you were working as active members, the city contributions. Then we take that money and we invest it in the public markets, well, not just public markets, the markets in general, including private, and so we get a return. So the combination of all those come into the bucket, and then from here, when they grow their assets, and from here, we take those assets and use it to pay what you get every month, which is the retirement benefits, and also to discharge the duties of the office, we have administrative expenses, and so that's a much lower amount. But I just wanted to sort of provide you, in essence, how the plan works. Obviously, this is federated because we're close to 50% funded. Same concept for police and fire, which is higher funded, about 77%. You good? Next slide. Let me make sure that I do this right. Yeah. Oh, really? So, this is, I just wanted to show you in one slide the end result of the evaluation. What you have in here, let me go to this side. Obviously, this is the pension, and it provides you information from last year evaluation to this year. And this is the OPEB, which is the same thing as healthcare. It's other post-employment benefits. When I said OPEB, I really mean your healthcare benefit. So starting with the pension, as Jay indicated, for June 30th, 2018, we had about $2.18 billion in assets compared to a total liability of $4.1 billion, which means that out of the total liability, about $1.92 billion are unfunded, which leaves the plan about 53% funded. That means for every dollar of benefit that we owe, as at that particular time, we have 53 cents to pay for it. For the OPEB, the story is a little different. That rate has been going down since I started working 6 years ago, from the low 60s to the low 50s. OPEB is the other way around, it's been going up. The current information is 42.6% as status of the funded ratio. And as Jay indicated, here we have what we call the discount rate, which is really what we assume our returns are going to be in the future that we invested in the market. So the board decided this year to bring it down from 6.875 to 6.75. That is a key issue because for federated, any 25 basis points, meaning if this goes down, it went down 12.5, but if it goes down 25, that alone increases this number, this liability, by about $140 million. every time that discount rate goes down 25 basis points or 1/4, 1%, everything else equal, it increases the liability by $140 million. So that's a big part of an issue that is, I always make a point to any stakeholder that I'm speaking to, because it increases that liability of the plan. If you go to the next slide. So what I wanted to give you here is, can we move this a little out?
Go. That's the bottom
That's,
showing on here.
oh really?
Yeah. Go.
Okay. So what I wanted to show you was,
There we go.
is that even a lower number? Yeah. Okay. So I told you in the other slide that the total liability of the plan was $4.1 billion. I wanted to show you here where those liabilities, where do they lie? So $4 billion and $47 million is just tier 1. So the bulk of the liability is tier 1. Only $53 million are for liability for tier 2. And even more important to understand is that of the total liability, 2/3, or about $2.77 billion are for the retirees. $1 billion is for the active members currently working. $233 million are for members that they're still working, they're deferred because they are entitled to a benefit from the plan, but they have not retired from whatever they're working today. When they do, we have to start paying the benefit. The reason this data is so critical to understand is what that really means is about 67-68% of the liability is retirees. That means two things. It means there's less money coming in from active members to the plan, and the ratio of retired members to active members is more than 1-to-1. And so that has implications to how we run the system. It has implications on how we manage the investments, because having that kind of ratio means that we are very sensible to impacts in the markets. And so we are trying to limit those impacts in the market so that, because the plan is very sensible to that, we can limit the impacts to the members and also to the plan sponsor. If this was the other way around, where the bulk of the liability was on the active members, that would mean a lot more money coming in, and we would be less sensible to impact on the market, which means we could take more risk. This is the opposite. We have to take less risk. If you go to the next slide. And what I wanted to show you here, I was just talking about the total actual liability. This slide is strictly about the portion of that total that is not funded, that is yet to be matched by the assets. So for the pension, that's $1.92 billion. For the OPEB, is $373 million. And so all this graph is trying to do, this slide, is giving you a sense of how we went from last year at this number of 1.822 to 1.92. And so we actually, when the city made contributions every year, and they make contributions to pay for the normal cost of the benefit, and they pay interest on the unfunded liability. So that was $4 million. There was some increase in the liability related to Measure F. Do you know what Measure F is? That was the latest measure by the city. And then about $55 million just on assumption of method changes. The bulk of this number was related to the decrease in the assumed real return from 6 7/8 to 6 3/4. The liability should have gone up from $1.82 billion to $1.882 billion. However, the liability actually at the end of the year was $1.92. What that means is that we actually had an experience loss for the year that added another $38.4 billion to the liability. And experience losses means I can stand here every year in front of you and I can give you all the numbers. And these numbers are actually the results of calculations that we make, but they're all based on assumptions. How much We assume we're going to make in the market. We assume how many of the active members that are working are actually going to retire and get a benefit. How long all of you are going to live. Some of you are going to live longer than others. How many people are going to file for disability. That all those decisions are based on assumptions that are based on experience. And every year we measure what we are assuming to what actually happens. And what this means is that we were off on those assumptions by $38.45 million, off on the negative side, not off on the positive side. That's what that means. If you go to the next slide. Now this is a concept, what I'm trying to explain here, so I spoke about the total liability, I spoke about the unfunded liability, I wanted to talk about the actuarial value of assets. And the reason I wanted to show this slide, which I just presented to the City Council for the first time last month, is I don't know if you have heard the concept that when we do the evaluation, we use market smoothing, a 5-year smooth. That's what we use. We use a method that is called 5-year smoothing. What that means is that some of those slides had an actuarial value of assets, and they also see the actuarial value of assets compared to the market value of assets. The reason we use a 5-year smoothing is we even further try to limit the volatility of the results that we have on the market, ideally so that we can help the plan sponsor manage the payments so that one year they don't have to pay 150 million, so the next year they have to pay 300 million. So we try to keep it as consistent as we can. And because of that concept, we use market smoothing. And what that is over 5 years is that instead of taking this year returns, the results, we actually go back 5 years and we take 20% of each year, which is 100%. That means that for every year going back 5 years, we only recognize 20% of the results for that year. And what the impact of that is in here. So I'm not going to speak about police and fire, but I'm going to speak about federated. And I think this is a very important concept to understand. When we measure this, actual expected and gain and loss, we're not talking about whether we make money or not. We're not comparing that to zero. We spoke about the discount rate. We assume a 6.75% rate. These numbers are compared to that number. What are we expecting to make based on the assets that we have on hand if we actually return 6.75%? That's the comparison. And then from there, we decide if we actually make money or we fail to meet the assumed rate of return. So when you go back 5 years, the actual earnings, say I'm going to use 2014, was $264 million. Based on the discount rate at that time, we were expecting to make $130 million. That means we had a gain of 137.76. For the valuation for this year, we only accounted for 20% of that. The reason you see zero here is because that was the last 20% to be accounted for, right? Because this is 2014. So in 14, we accounted for 20%. In 15, 20%, that's 40. In 16, 20%, that's 60. 17, 20%, that's 80. 18, the last 20%. Now we finally fully accounted and recognize the gains for that year. And so for the other years, right? So in 2015, we were expected to make $142 million, but we actually not only didn't make any money, we actually lost money. So we actually ended up losing $60 million. So the total delta difference between what we were expecting to make and make was $158 million in the negative. Again, we didn't account for that whole amount that year. We only do 20%. The reason you have 20% left is this is what is left to be recognized, or the amount that has been deferred, because this is 4 years from now. The 2015 is 4 years from now, right? It was 4 years ago. We accounted 20%, 40, 60, and this is the 80% that we have accounted. We still have 20%. So when you take that concept across the last 5 years, it means that on all those 5 years, the total loss was $205 million that we did not meet the expected return. We account a portion of that, which means that as of June 30th, 2018, we still have $110 million of deferred losses that we have yet to recognize. What that means is that if we, on an actual market value in 2019, we meet the assumed return of 6 3/4, from an actual value, we're going to end up returning less because we still have to recognize a portion of that 110 that we have yet to recognize. That's the reason why your market value of assets is lower than your actual market value, because from an actual standpoint, we still have yet to recognize that $110 million difference between the actual value and the actual market. It's a very challenging concept to understand. I'm happy to address issues on that, but it took me years to really grasp this concept. The main reason for presenting this is twofold. You had a question?
Yeah, what kind of assets do you have besides equities? Because the moving average for the stock market has gone up considerably.
Yeah, so Jay sort of touched base on that a little bit, at which our chief investment officer was here, but about only 30% of our assets are invested in equities. The other 70% are invested in all the gamut of different kind of assets like fixed income and private equity, which is private investments, or hedge funds, or all the kind of investment, real estate. We don't invest all in equities. And so the best explanation I can give you, clearly, if someone would have told us 10 years ago with 100% certainty that the economic cycle for the last 10 years was going to be like it has been, clearly we would have put the money in equities, right? But you cannot predict the future. The way you have to think about that is, imagine if we would have 100% equities in 2008 when the market went down 40%. That's the reason why, as a fiduciary of the plan, trustees like Jay make sure that we are properly diversified. That means that when the equity market is going up, we may be earning a little less than other systems. Remember when I was talking about the fact that we are very sensible to financial impacts? Because we're very sensible to that, we try to be a little less risky than our peers, which means we have less equities. And that's what that means. So you're right. I wish we would have all on equities for the last 3 years. The story would be different, but from a fiduciary standpoint, we have to make sure that we make prudent investment decisions, and it wouldn't be prudent to have everything in one asset, particularly in one asset.
There's a big difference between 30% and 100%.
Yes.
You know, you're not, it seems like the stock market going back to 1929 and looking at the ups and downs, and we're a long-term fund, that something higher than 30% would have been rational living in 2008.
Absolutely right. It would have been better. And in fact, in 2008 and 9, we were about 60%. And right coming out of that market, they kept the 60% to about 2012 and 2013. And then I believe the trustees at the time, by 2013, the market has been back for about 4 or 5 years. And they decided they couldn't afford another downturn like they had in 2008 and 9. And at the time, I'm just trying to explain what was their thinking. At the time, when they were looking at that data, they realized that the average economic cycle was about 4.5 years. And they felt at that point, they were reaching that average, and they figured, the market may go down in the near future, let's take less risk. And they purposely decreased the equity allocation from maybe the high 50s, low 60s to a lower in the mid 30s. That was purposely done. Now, the rest is history, meaning what they decided based on the data at the time made perfect sense, and from a fiduciary standpoint, I think that you can defend the prudent decision. However, we can't predict the markets, and the markets continue going on. And so certainly, yes, we missed part of that. We haven't missed the whole increase, but we haven't had the allocation to equity that other systems have, and so we haven't participated as much of it as other systems has participated. Yes.
Two questions. At that point in time, did most of the pension funds all across the country for the government agencies, did they do the same thing
Well, first of all, I can't
or
speak.
similar?
I think the short answer to that is I do not believe so, but I can't speak for other plans. Obviously, I don't work with them. But what I can say is that they decreased their allocation, but it was they didn't go down as much.
Then one other question. Are we seeing this right? The police and fires got a lot more than the federated folks.
You mean in terms of assets?
Yeah.
Yes.
And yet there's a whole lot more employees on the federated than there is in the police department. And we were told they all die early, and so there's less of them to pay. And so why is there even a penny above ours when we have a huge number of employees kicking in money, and they apparently don't?
Well, so first of all, they do. They don't die early.
Well,
That's the
we're
first
told
one.
they all.
They may be less, but they still put money into it, and the contribution is a lot higher than the federal
But
contribution.
we're told that, this is what I've heard.
I don't know who told me that. Who told
A
me?
lot of people, they go out on disability and they die early. That's what we've been told.
Well, that's a misconception. That's not completely true. But the main reason they have the larger, okay, so they have higher contributions. They have a higher funding ratio, and I can explain to some extent. I can explain, and I will do it in another slide. The reason for the funding ratio staying higher than our funding ratio for the rate. Now, when I came in 2013, the delta between one and the other was already there. In fact, since I've been in the office, out of the total plan assets, they account for 60% of the assets and federated for 40%, and it's been like that since I got there. So I can't really speak to before that, but I can speak as to why the funding ratio has sort of stayed in the mid to high 70s, and federated has been going down. I will speak to that in another slide. So, yes, sir. I'm going to answer one more question, but then I'm going to keep on going, and we can continue. Yes.
Is there a difference in the contributions between Tier 1 and Tier 2 employees?
Yes, and I will get to that slide. Yes. So, okay. So what I wanted to show you, if you can go over there.
Yeah, I can fix it.
Yeah. I wanted to show you this. This was the slide. So obviously, when you make presentations, you think of the audience. When I went to the city council, that was the first slide that I presented, right? Because in all honesty, that's all they care about. How much we have to pay next year. So what I'm presenting here this morning, which is the actual evaluation for 2018, is this year, which actually one of the goals of the evaluation is to provide us with what is the actual contributions by the employer for the 2019-2020 fiscal year, which is forthcoming, right? And so for the city, the total contribution is going to be $412 million, compared to about $382 million for the fiscal year that is ending on June 30th. That's a $30 million difference. Of course, for police and fire, 210, for federated, 202, and you see the split between pension and OPED. In your case, pension is $180 million, OPED for healthcare, $22 million. All right, so that was the goal. Obviously, this is a slide that is very important to the city council, but I wanted to share that with you so that you see what is the contributions, what are the contributions that the city is making for the year and is going to be making next year. If you can go to the next slide. So here is the answer to your question. Someone asked about the contribution. This is the summary of contribution just for pension for federated employees. A Tier 1 member actually pays 7.6% of normal cost. A Tier 2 member actually pays 8.33%. Now you may ask why, because the Tier 1 member benefit is higher than the Tier 2 member benefit, right? And the reason for that is Tier 1 members have had an agreement, and I believe all of you are Tier 1 members, with the city that you pay 3 of 11 of the contribution for normal cost. The city paid 8 of 11, right? So you didn't pay half for your cost, and the city paid half. You paid 3 of 11, and the city paid 8 of 11. For Tier 2 members, even though that benefit is lower, that normal cost is split 50-50 with the city. That's the reason why they pay higher contributions at Tier 1. The city, you remember in the other slide, they pay $180 million on pension, which is this number, 179.6. Out of that, out of the 180, $138 million is just to pay the unfunded liability, just to pay that down. 28.9 million is for the normal cost of administration for Tier 1, and for Tier 2, $13.3 million. That's what comprised the $179.6 million for the pension plan from the city.
Roberto?
Yes.
So what this is saying, regardless of the funding ratio being in the 50%, this represents a commitment of the city for pension obligations to put in that extra money under a 30-year program that would, under the assumptions of return, get to a fully funded.
Yes, and I have on the slide that I will speak to that, but yeah. And it's no longer 30, but I will speak to it. So if you can go to the next, then Jay, if I say something and you want to jump in, feel free. Okay, so this is critical. This is a great slide. We presented this to the City Council. I mentioned before that I was going to some extent explain why the funding ratio for police and fire has remained sort of constant since I arrived to the office in the 77% versus federated has actually consistently going down from about low 60s to low 50s. In fact, the decrease from 2017 to 2018 for federated from 53.6 to 53.1% was the most consistent change between years as I got here. And this is the reason. You see this payment here on the funded liability principal, because the number that I presented before, the 137 million on the unfunded that the city is paying, is just like paying your mortgage. Out of the 137 million, a portion goes to pay your principal on your mortgage, and a portion goes to pay your interest. So you know when you buy a house, in the first few years, you pay a lot more interest and you pay a lot less principal. When you get into the end, you pay a lot more principal, a lot less interest. Well, this is key to that reason. You see police and fire of their UAL payment, 46 million went to bring down the unfunded liability. For federated, for the $137 million, only 5 million went to pay down the principal. The rest was to pay the interest. And the reason for that is this. Police and fire, for many, many years, even before the debacle in 2008, they had decreased the amortization of those payments. They were already down to about 20 years amortization. It's similar to having a 20-year mortgage. Federated did not. And so Federated, for a longer time, have what is known as a, which is no longer legal to do, what is known as a 30-year rolling amortization, which is similar to you making a mortgage payment in your house every year based on a 30-year rolling that never goes down. So you know what happens when you do that? You never pay off the mortgage because it's a rolling 30-year on your interest, right? So the board in 2008 decided, or 2009, decided to close that 30-year amortization, which meant that in 2009 it was 30 years, 2010, 29, 2011, 28, and so on and so forth. The challenge with that is that when you take that approach, you don't really pay principal on your funded liability until about your 23rd or 22nd year. So the reason everything is equal, one of the main reasons the funding ratio for federated was somewhat consistently going down over the last 6 years is that for the last 6 years, the payment for the funded liability didn't even cover the interest that was being charged. It was just last year and this year, the first time that we start paying down on the principal. So that's the reason why the federated funding ratio was consistently going down. I mean, that's one of the main reasons. There were other issues besides that, but that's the main reason. And police and fire did not. All right? If we go to the next slide, please. I'm so sorry to bother you.
It's exercise.
I just wanted to also, I spoke about the contributions for pension. I wanted to share with you the contributions for the healthcare. You all know about the Viva account the city created just recently. And so now all Fed members, the people have the right to decide whether they wanted to stay in the healthcare or they wanted their portion of their contribution moved to what is known as a Viva account, which is really described under a particular code section of the IRS. And so they to put the money outside there for them for their own account, and then they will put about, I think it's a 2 to 4% contribution they make, versus all the people that are elected to stay with the healthcare plan. I'm gonna assume, I wasn't one of them, but I'm gonna assume that the bulk of the people that remain here were already either vested in the healthcare benefit or they were close to it, all right? So going forward, they actually pay 7.5%. So when they make a contribution, the healthcare contribution is 7.5% of their pay. And then the city actually is making a $21.8 million. I only added this over here. Is there some on the bargaining contracts that the city has the ability to put a cap on how much they're going to make contributions for the healthcare. That cap is actually 43.2 million, so obviously they're just halfway through it, so there's still plenty of buffer there. But in a nutshell, Fed member rates are 7.5%, and the city for the upcoming fiscal year is paying $21.8 million. We can go to the next slide. Oh, so that's in essence the presentation, but I wanted to go over some slides quickly here. I mentioned that we have some data that compare the information from our plan to other plans in California, so I wanted to show you that. If we can go to the next slide. So this is the first one. What this shows you here is our funding ratio compared to other public plans in California. This down here, that's federated. Here is police and fire, and on the side, I just wanted to show you, there are two plans in California that have, since I moved here, I've been working in California for 20 years, they've always been 100% funded. They are the two Fresno City plans, one for police and fire and one for general employees. Below that, there's LA Fire and Sonoma County, they're in the mid-90s. The lowest, Merced County at 63%, San Diego Transit at 55%, and San Jose, the lowest at 50%. Yes?
Did you happen to look at the asset allocations of those cities that are well funded, the 90s?
So, no, I did not. And the reason for that is we need to invest and we need to have an asset allocation that makes sense for what our challenges are. Clearly, people that are already close to 100%, they don't have the same situation that we do. So, for us to take a look at that allocation would not really answer what we have to do. For example, if you look at something like 135%, 129, I would argue that they want to really be very, not take a lot of risk and be mostly in fixed income, which is T-bills and bonds, because they don't have to take a lot of risk, because they actually have a clause, right? But we can't do that. We have to find a way to invest on assets that allow us to get to that 6.75, which is one of the reasons why we have more, and the reason is twofold, we have more private market and more alternative investment than most of our peers. And the reason for that is we believe strongly that those are the areas that most of the returns may be available in the future, but we also do it because it provides a diversification to the investments, which means that in situations where the market goes down, we go down, but not as much as our peers. In fact, in the last quarter of 2018, you remember there was a huge downturn on the equity market. we lost money like everybody else, but we were in the top 10% of returns for the nation on public plans. Many of our peers were 50% or even lower. Now, like I explained to my staff, there's no way we can come to stakeholders or go to the city council and tell them that we're excited that we only lost 2% because we still lost money. But what we can say is that because we are more diversified than some of our peers and we take less risk than some of our peers, in downturn economies, we're going to lose less assets than our peers, which is critical for a fund when you are 50% funded. It's a lot harder to climb out of a hole than when, the lower you get. And we don't want to continue going down that path. We feel strongly that with the economic cycle right now at 10 years, that at some point that's going to change. And we want to make sure that we don't make changes exactly at the wrong time. So we have kept that defensive approach, and that's why we don't invest in many equities as many of our peers, and why we also, just to answer your question, we don't look about what all the plans are doing, and I have some of the slides to explain that reason, but one of the points that I'm trying to make with the other slides I'm going to present is that we are different than our peers, and therefore we make decisions that may differ from what they do. So if you go to the next slide, Jay mentioned this in the presentation. This is just a range of the assumed rate of return, so discount rate from many of the pension plans across the state of California. And as you can see, the bulk of them are at 7% or higher. We are at 6.75. There are 3 here. 2 of those are San Jose Federated and Police and Fire. There's only 1 down here that is San Diego City at 6.5. And the main reason San Diego City is at 6.5, you may recall, I was in Puerto Rico when that was happening, but I was probably know what was happening in California. The 2 cities in California that evoked pension reform were San Jose and San Diego, right? And you know the story about San Jose. I don't have to give you that one. You live there yourself. San Diego actually moved forward, and not for police and fire, but for general employees like yourself. They actually discontinued the defined benefit plan and opened a defined contribution plan, like a 401k, that says that in government it's 457, for new employees. Well, doing so means that you have a closed plan. When you have a closed plan, that also has implications how you can invest the money. And you have to, because it's closed, you have to be more conservative. Thus, their decision to go with 6.5%. Now, that may come back eventually because, I don't know if you know, San Diego and that decision is actually going to the Supreme Court in California to be decided whether they actually have the right to close the plan or not. And I don't know what the final decision is going to be, but what I hear about is that at some point they may have to decide. I don't know if this is going to be the case, but there's a lot of talk about possibly, hey, they may not have to open the plan, but they may going to have to offer something of a benefit to those employees to make up for the fact that they closed the plan, right? But anyway, long story short, this is what we are, as Jay indicated, we are more conservative, and our asset allocation reflect that we expect to have less returns than other systems. One data point that you won't see here, because this is not an investment presentation, when you measure your relative risk on your asset allocation, is measured by the standard deviation. That's what measures how risky your asset allocation is. And our standard deviation number, the board went through a lot of studies and a lot of work with our risk advisor, and the goal is to keep it below 12%. So our standard deviation for both plans is under 12%. If you look at the standard deviation numbers from other plans, it's going to be higher than 12, meaning they're taking more risk. And that's good when you can take the risk. You have the ability to sustain that risk because of your plan assets and your funding ratio and your plan sponsor, which I will speak to in a second. And when the market goes up, that's fantastic. When it goes down, it's a big problem. Another issue that these boards have to think about, that other systems, they may or may not, is we think about the plan sponsor. And the reason we think about the plan sponsor, well, number one, is like if I was a bank, I was giving you a house and a mortgage, I want to make sure that you can pay me back. But we want to make sure that the city can make the contributions, right? And San Jose is one of the 2 or 3, not only across the whole nation, but in California, that have the highest percentage of contributions for retirement costs from the general fund. So that's another reason why, just got your question about looking at other plans and this allocation, where San Jose may be in the 25 to 30% of the general fund. All the other plan sponsors are maybe in the 5, 10, 15%, which would suggest, I do not know the economic situation of different plan sponsors, but at a rate of low teens suggests that there is more room to be paid from the general fund. In San Jose, the vibes or the sort of like the unofficial input that we're getting is that they're getting to a point that is really cannot continue going up. It's hard to manage. So those are things that we all have to keep in mind when we're making decisions about the asset allocation. We go to the next slide. I spoke about the ratio of retirees and different members to active members. It's called the support ratio. All I want you to get from here, this is police, this is federated. They're both about 1.6. If you go to the next slide, they're right here. This is the rest of our peers, we're up there. So that's the ratio between members receiving benefits or members that are deferred vested that will receive a benefit in the future versus the active members, right? The reason this is so critical is because I spoke earlier about sensitivity of the plan. It makes our plan a lot more sensible to market fluctuations. Thus the rationale behind having a less risky asset allocation. I just wanted to make that point. And that number is probably not going to get much better. And it's actually exacerbated by the fact that, as I presented earlier, the bulk of the liability in this system is Tier 1. And guess what? We are not going to be getting more Tier 1 members. That makes Tier 1 sensitivity even more of a challenge. So if we go to the next slide. I also mentioned we're getting to the end. If you let me, I'll stay here until 3 o'clock because I love speaking about these things. But I also mentioned about the payments to the funded liability and the difference between paying interest and paying principal. Well, again, this is just a measure of the interest cost on the UAL. Fed, right here, the highest in the whole state, 44%. Another reason why we have to be mindful of the asset allocation, because any fluctuations in the market will have an impact on increasing the funded liability. We don't want to make it worse. San Diego City, I explained that. They are close at this point funded. And then after that, you have police and fire. If you can go to the next slide. I gave you a table with the actual numbers, but wanted to show you how the liability is spread. I'm going to keep it to federated. So, looking at the whole pie chart for the liability, out of the $4.10, which is the $4.1 billion in liability, $3 billion is for members that are no longer in the plan. I mean, you guys are in the plan, but you're not active. You are either retired or invested. That again, another reason we're very sensible to market fluctuation. Another reason why we have to keep that in mind when we do this allocation. If we go to the next slide. I'm trying to remember why I presented this one over here. Oh, I wanted to show you the funded actual liability for federated, for both pension and OPEB. You've seen the information on separate tables, but not together. So again, the funding for pension was 1.9, for OPEB was 372, so 73 million. So combined, the unfunded liability on an actual basis for Federated is $2.3 billion on an actual basis. You remember, I showed you the slide where I showed you why the actual value of assets is higher than the market value. So on an actual value of assets, the unfunded is 2.3, but on the market value is $2.4 billion. The difference between the two, the $110 million on deferred losses that we have yet to recognize that I showed you in that 5 market smoothing, that was the point of this slide. We go to the next slide. Oh, wait. And for the total, for the whole city, when you combine Federated and Police and Fire, $4.2 billion. We go to the next slide. I wanted to just give you a sense of, this is a projection of contributions, assuming that we meet all the assumptions for the years to come. So I'm going to speak just to Federated. These are the contributions that we are indicating to the city to make this year. This is the city, these are employees, 180. You see they're going to continue going up pretty much until past 2040, but once we get to 2023 and they go to $200 million, we don't expect it to go down, actually climbing to about $261 million in 2037. So this is what we show to the city as well. And a big qualification here, which I mentioned at the joint meeting, this is based on assumptions. And guess what? We know that assumptions are not going to be right. Sometimes they're going to be on the positive side, sometimes they're going to be in the negative, but everything else equal, this is what you can expect the city to make contributions for Federated for the next 20 years or so. Is that the last one, or we have one more?
We're done.
So that concludes my presentation. I'm hoping that I gave you some background and some data points that you didn't have before. I want to thank the board for inviting me here. I look forward to speaking to you every year when I come before you. And usually it's about actuarial issues, but I'm actually happy to speak about anything else. So with that said, I'm happy to answer your questions. Yes?
Do you have any idea what the percent of fees are compared to our assets?
I'm sorry, say that again?
What we pay the investment companies and all? What percent
Yes.
is fees?
So we pay on money manager fees about combined about $65 million a year between Police and Fire and Federated.
I can't do the math in my head, but what percent roughly would that be?
Oh.
I mean, is it like 1% or?
No. About 1.10%. Yes.
So it sounds like San Jose, above average, needs more money kicked into the fund, right? Is that what I understand?
Well, we need more money to get to the fund, but I don't know what you mean by above average.
Well, compared to all the pension funds and public pension funds in the United States, average. I mean, I thought you said City of San Jose needs more money than average.
I said that the City of San Jose in the general fund paid considerably more money when you look at the contributions based on a percentage, because of the fact that, in fact, for Police and Fire, contributions are based on rates, based on total payroll. I think San Jose is probably one of the 2 cities in the state that for Police and Fire, from a Police and Fire payroll standpoint, their contribution is more than 100% of the payroll. That doesn't happen in any other place.
Okay, but you implied that it's going to get worse in the future. And my real question is, knowing this, and knowing there is going to be a future, is the board and the people in charge of brainstorming and coming up with projections? How are we going to deal with this? Because if our fund was to ask the city council and the taxpayers for even more money, when they're seeing what, 40% of the entire city budget goes to us?
So
I thought it was 40 out of 100.
that was the reason, that's one of the reasons why we have these joint meetings with the city council. And that's one of the reasons why there were some slides in here that were presented to them at that meeting, but the presentations, as Jay indicated, if you can watch it, it has other data points from the business standpoint. The point was to give them a pretty good idea as to what are we facing, what are the challenges ahead, so that we can work together on how we're going to address those issues. But your point is well taken.
Well, the hypothetical, I don't know if I understood it here or not, but while some people, myself included, would have liked to have sent a more aggressive asset allocation model with this bull market with higher returns, if in fact it's less aggressive and less volatile, which it is, and the city was to experience a bad downturn similar to the financial crisis with the stock market decline,
Yes.
you're indicating that ours, relatively speaking, would be less hurt.
Yes.
And so therefore, a city with a bad, fragile tax base would not get a double whammy of a hit to returns that were too risk-taking. And might, in fact, in a screwed way, help the city avoid or help us keep the city from having to make a find in fiscal crisis.
So that's the concept, right? And you know, this issue was addressed at the joint meeting. In fact, what I gather is that there's an understanding in general of why the discount rate was real return is what it is, and the possibility of even going further down. And they understand that. They also made the point about, you know, they provided to us, they opened the meeting with expectations from the budget for the next 5 years, sort of a rosy expectation, more that they think that could happen, or a very negative one. And so that was the point. I said, you know, and we also understand that it takes about 18 months between the actual downturn happening and having a full impact in the city budget. So we have about 12 to 18 months to try to find a way to be mindful of that and understand how we can be helpful.
So the city council has effectively said, we'll stand by our commitment
Yes.
of a 30-year closed system, because we'd rather do that and make those contributions than take the risk of some financial crisis
Yes.
again.
Yeah, I mean, I can't speak for the city council, but all the indications that I have gotten to public meetings and everything else is that they are committed to make the payments that are required to be made. But we're also mindful of the impact of that commitment, and so we're trying to walk a fine line between, number one, making sure that we make fiduciary decisions that are in the benefit of the members, while at the same time making sure that we keep in mind the implications of the plan sponsor. Yes. Any other questions? I'm happy. I mean, we can talk. I'm not even hungry yet.
Okay, well, you said you stayed till 3, so I got a couple extra hours.
Okay, very good. Yes.
I did expect somebody to ask about that extra line on the paychecks.
The annuity.
Oh,
What's happening?
yeah. So she was addressing the extra line in the paycheck, and so you're going to be receiving. I don't know if it's going to be your May paycheck. If it's not May, June. And guess what? If it's not June, July, but you will be receiving your paycheck with a letter, because there's going to be one more change, addressing the changes in your pay stub so that it's well understood. All right. So I'm mindful of that. You know, my mother is retired. So is my sister. My dad is gone now. God bless him. But I'm always mindful of the implications and how difficult, and making sure that we communicate with the membership, including retirees. I know that there's always, we can do better, and we stand behind that. We want to continue doing better. We can always improve. And so in any case, we will send a letter with the same month that you receive the new pay stub, explaining, so that you understand whatever changes you may see. And if you have any questions, after reading the letter, please contact our office.
Is the annuity line going to continue?
The annuity line, I believe, is going to continue. I also wanted to mention when Jay made the presentation and spoke about the pension administration system, the PAS, we are working on rolling out, possibly sometime in the summer, what we call the Member Direct, which is for you to access your data directly, and there might be a way that you can make some changes to some information. Other ones we're going to have a signature, but that's and again, before we roll that out, we're going to be reaching out to you with information so you can understand and can understand what could be expected to help you through that process. The concept is really to be more transparent and giving you more access to your data. So ideally, you feel that you have more control over the information, but by the same token, the more you can do that, hopefully, the less you have to contact our office. And so it helps with how effective we can become to provide service to the membership.
Roberto, so that annuity, is there some tax or IRS implication to putting annuity in there?
No, there is no tax implication of that.
Is there some reason why it's made?
I don't have the patient in front of me, so I can't refer to it because I will have to see it. But there are no tax implications for adding that. There was another question? Yes.
I was wondering if this data will include the system like a prospectus, investments in general, rather than just what your return might be.
I'm sorry, I couldn't hear what you were asking.
Okay, do we have access to what the system's investments are?
Oh yeah, I mean,
like
if you,
prospectus?
so yes, in our website. Now that's another thing that I can tell you needs to be revamped and it has to be better, more user-friendly. When I interviewed for the job 6 years ago, I accessed the website for the office and it was so bad that I actually have to call the office for data. So, but that said, I think that now we try to be a little more up to date with the data. So, but one of the goals that we have for the upcoming 2019 to 2020 year is to revamp the website to make it more user-friendly. But you don't have to wait for that. If you go to the website now and you go to the investment section, there are reports, information on what the monies are invested on, what are the returns on a quarterly basis. So this data, but that goes not to the member portal, that will go to access to the website. There was another question, yes.
Roberto, how do we compare to CalPERS and PERS in terms
So,
of grant funding?
Can I ask you a question? When you
Yes.
say how do we compare, what is it that you want to compare?
The health of the system.
The health of the system, okay. Well,
My wife is
it's called,
hopefully going to be CalPERS.
yes. Okay, so a couple of things. It is important that when you look at health, one system to another, it's not enough that you look at the data. Say, for example, CalPERS is about, I think, 68% funded, right? And we are about 53.1% funded. It's not enough to look at that. You actually have to look at the information provided. You have to look at what the assumptions are. You have to look about what is the assumed rate of return. Because when I first joined I just going to give you an example. When I first joined the office and I went to make my first presentation to the city council, I think I got them scared, which not what I was intending to do. When I told them that, just to answer the question, when you look at an accurate report, you have to kind of look under the hood. Because if they just look at the main data in the report, at that time when I went to talk to them, it was very similar to the city of Detroit, who were just going through a bankruptcy, all right? And they were like, oh my God, really? Well, my point with that was, if you look at the numbers, you will have not seen a difference at that point when I went there between the city of San Jose and the city of Detroit. Yet, on the one hand, the assumptions were completely different. And then the other issue, I can't speak for the health of the state of California, but the health of the plan sponsor is key. So in my example with Detroit, there's no way you can compare the health of the city of Detroit, which was, their population had decreased more than 50% over the last 30 years, and the number one business, which was the auto industry, is in the debacle compared to San Jose. So you have to look at more than just that. Having said that, to answer your question, I don't know that I can say that they're in very health that we are, or that we are better than them. What I can tell you is, I feel very confident that the assumptions that we have in the plan are very reasonable and more conservative than many other plans. Any other questions?
Could you explain very clearly, if there is a catastrophe after decisions are made, who exactly is responsible? The 7 board members who vote on decisions, or the city council, or who?
Well,
Who is responsible for making decisions if there's a catastrophe, negative catastrophe?
so let me make sure that I understand. Are you saying if there's like a great earthquake, something happened?
No, no, a financial, because of
you're
making
saying there's a
decisions.
catastrophe in the decision that we made?
Yes.
All right. So again, it's funny because yesterday I sent to some trustees a short article on that speak about fiduciary duties and speak about decision making. So I'm going to answer that probably not the way you were expecting, not the way that you wanted, but the way that I think is the right approach.
I'm just wondering.
No. What's important about a decision is the process. Okay? Trustees of the plan, they have to be prudent and they have to be reasonable. That does not translate into always making the right decisions. So what is important is that we have a decision and a process that can support the process by which the board went to make a decision, and then on top of that, that based on the information available at the time, that the decision that was made was a prudent decision. In other words, it's a decision that someone else with the same kind of knowledge, in the same kind of information, will make a similar like decision. So we could never avoid that. Like I tell my trustees, I work with 4 different boards in my career, and I can tell you without a doubt, of all the boards that I have worked, the boards that I work with today, when they make a decision, they know why they make a decision. Knowing why you make a decision, knowing the data that you use to make a decision, and knowing that you were prudent making a decision does not translate to making it the right decision. It just means, under the circumstances, with the data that you have, it was a good decision. But that doesn't mean that it's going to pan out the way you expected. So I'm staying away from catastrophe, right? Because if there's a catastrophe, I read that to mean we make investment decisions, but if the economic cycle goes down like it happened 10 years ago, when no one is expecting that, everybody's going to be in the same situation. What's important about decision is that we can look back and defend it from the standpoint that there's a process that can be explained and there's a decision that is prudent. And the example that I can give you is, I think the gentleman before asked, which is a fair question because I would ask the same thing. I don't think Ed is going to leave. Ed? You leaving me here?
Yes, I don't know what appointment.
Okay, well, good to see you, Ed. And go Warriors, right? Very good. Good to see you. You're welcome. So that's why I took time to explain that in 2013, you're correct. Many of the systems, they may have decreased the equity allocation from 60 to 55%, and we went from 60 to 40. So we did more than most people, okay? Now, and that decision obviously has an impact on the plans in terms of the returns, obviously. But when you look at the data at the time, when you look at the had before them, that they were already past the average length of an economic cycle, I don't think that you could say that the decision that they made was a bad decision. It wasn't correct. It didn't work out. But given the data they had at the time, it wasn't an incorrect decision. I think that's the kind of thing that we have to think about when we make decisions to make sure that we have a process established and that based on the data that we have at the time, it can be defended and is reasonable. I know I didn't completely answer your question, but that's, yeah.
Round of applause for
Thank
Roberto
you.
and Jerry here. Now for the second half of this presentation,